This is not financial nor professional advice. This video is for entertainment only. Hey everyone, we are in a bear market and I think it could get pretty bad. And if there's a message I want to get to everyone, it's please don't feed the bears. Because if you buy a rally at this stage, you are just feeding the bears, you know. And another saying could be right now, not always. In a bull market, it's a smart thing to do. Right now, it's not a smart thing. Right now, you have to be a dip to buy the dip. It just isn't going to work. Okay. They're going to announce the first interest rate increase probably in March. We hope it's not sooner than that, but nothing would surprise me. I think they're going to raise it. Well, we know for sure they're going to raise it to 1%. But if inflation is bad, they may have to go to 4 or 5% ultimately. But we hope it's somewhere in between and they stop like at 2 or 3%. That would be the best case scenario, I think. But I want to tell you the specific inverse bear funds I've been buying. And all of them are triple leveraged except for the first one. The first one is SH, and it's a bear fund on the S&P 500. For every dollar that the S&P goes down, this fund goes up $1. So it's a 1-for-1 situation. All the other funds I'm going to be talking about are triple leveraged. For every dollar that the particular index goes down, the particular fund will go up $3. They're triple leveraged. So I bought some SH. I also bought SQQQ. I got to remember the 3 Qs. This is shorting the QQQs. These are the top 100 companies on the NASDAQ. And so for every dollar that the top 100 companies on the NASDAQ go down, this goes up $3. And these haven't come down enough. And so they have a ways to go. They have another 10 to 20% to go, maybe 30%. We don't know how bad this is ultimately going to get. One thing about a crash is different from normal trading. It always gets exaggerated. It goes down much further than it should. So after a while, the numbers don't mean too much. What means the most is how people feel about the market and how panicky and primal their fear is. This is a gut level, gut wrenching, tear your face off kind of fear that grabs people, and they're not looking at numbers. They're saving their money. This is a different response from me in some ways. Because I'm actively going against the market dropping and using it to my advantage. I don't recommend anyone doing this that's not familiar with doing it. I'm doing it because I'm familiar with crashes and how they act and can see what mistakes I've made in the past and what's worked for me in the past. And I've concluded that I'm really good usually at seeing a crash coming. Okay. Seeing the market take off, it can go sideways. That's usually a little less clear. To me, a crash, and the Federal Reserve has guaranteed it in my mind. I ended up buying the SQQQs and the SRTY, which is a triple leverage inverse fund on the Russell 2000. So it's mostly small cap stocks. So I bought those on Wednesday and I held my breath because I knew there would be a rally. Okay. Usually there's a rally at some point because people say, "Oh, the market's hit bottom and it's going to reverse." And these are usually people that haven't been through a crash, and so that happens. And on Thursday morning, it was up 400 points. Boy, these funds took a dive, and I had to look away from the computer for a while, simply because I knew this was a bull trap. This was a fool's rally in my mind, and the market, the shorters that know the market's going to crash, they jumped in and shorted and shorted and shorted, and it completely came out of the 400 points to the plus side, and ended up going down a couple hundred points. So at the end of the first day of owning these, I was up 50,000, you know, and so that night, what I did after hours is I doubled down, and I doubled down on both the SQQQs and SRTY. And the market, of course, continued crashing the next day on Friday. When it was all said and done, I made over $120,000 in 2 days. Needless to say, that's the best I've ever done during a crash. I mean, usually you just sit back and hope you lose less. To actually make money is like phenomenal. I was so happy that I doubled down on SQQQ on Thursday and on Sortie. Now Sortie, I sold that after hours simply because I'm shifting. I think you could still make money on Sortie, but I don't think you're going to do as well as you are with larger caps. I think a person will do better on SQQQ or on the triple leveraged S&P inverse fund, which is SPXS. SPXS. So that's the triple leveraged S&P inverse fund, because I think the final shoe to drop will be the S&P going down. When the S&P has gone down 20%, we should be close to the bottom. If they get carried away, it could go to 30, maybe 40% from where it is now. But I'm not expecting that. I am expecting 20%. So I think this is guaranteed through April, just because the way the market is. The only good sign would be in April if they don't raise rates, but I don't think that's going to be much of an impetus for it to go upside. That'll be an impetus for it to go sideways. And if inflation goes really out of control, they could start raising the rates by more than 0.25% at a time, and start doing 0.5% at a time, which I think the market would see as a panic time. And so I'd be really in good shape. So I think I'm in these funds until April, through April for sure, and probably longer. I suspect it's going to continue until October. And after October, we just have to see how inflation and the flu are doing. But I want to beg you, or not beg you, because I'm not advising you. I'm just telling you what I'm doing, right? I want to beg you to don't feed the bears. Don't buy into the rallies. They're bull traps. They're fools rallies. They're not. They're going to turn around on you, and I probably will get whipsawed at some point. But at that point, I will have made so much money it almost won't matter. Okay, so I'll try to keep you informed with what I'm doing with these. It's more conservative than just sh- uh, shorting an individual stock, simply because indexes are more predictable. It's a group of stocks. Uh, I was a statistics minor in graduate school, and statistics always favor. Statistics can tell you a lot what a group will do, but it's far less accurate in predicting what a particular individual will do. And so an index is a group of stocks, and they can you can it's just easier to predict a group of stocks, which is what an index is, only it's a particular criterion. It's a small stock fund, it's a large stock fund, that sort of thing. But I hope you've found this informative. Please like and subscribe if you feel this has been of value to you. Thank you very much for watching, and I will plan to see you in the future. Thank you.